Few words about gearing. So what is the gearing? Definition says that the gearing ratios are a group of different financial metrics that compare shareholders' equity to company debt to assess the company's amount of leverage and financial stability. Gearing is a measure of how much a company's operations are financed using debt against the equity financing. Gearing ratios, in simple words, have more meaning when you use them to compare your company against some other competitors or the companies of your industry. So what basically gearing ratios tell us? To make it very simple, a gearing ratio higher than 50% is typically considered as highly levered or geared. As a result, the company would be at greater financial risk because during times of lower profits and higher interest rates, the company would be more sensitive, let's say so, to loan default and bankruptcy. A gearing ratio lower than 55% is typically considered low risk by both investors and lenders. And finally, a gearing ratio between 25% and 50% is typically considered optimal or normal for well-established companies. For example, a startup company with a high gearing ratio faces a higher risk of failing. So those levels are important to keep in mind when we speak about the leverage. Formulas, there are a few formulas good to know. Debt to equity ratio, you take the total debt from the balance sheet, you divide by the total equity also from the balance sheet equity and liability side. Or times earned interest. Times interest earned, it's EBIT, earnings before interest and tax, that you can find in your P&L, in your income statement. You divide by the total interest that you also can find in the P&L, in the costs. So, and finally, equity ratio, total equity from the equity and liabilities, balance sheet side, and divided by the total assets that you can find in balance sheet as well. So those are some of the gearing ratios that most of the economists and that you can do as well when you calculate the gearing of any company.